Greetings, members one and all of the Salivation Nation. Well, the tides are turning. It's interesting to see what's happening with the markets today. We had a market that fell in the Dow Jones Industrial Average, down 400 points after a two-day loss of about 1,000 points, and now it's recovered above 83 points. Very interesting indeed, and gold and silver prices are reacting. Here they are. Gold is up a bit. Silver's actually a little bit down, but platinum and palladium are dropping. But palladium still is maintaining a level beyond and above gold as of now. But nonetheless, it's interesting to see where things are going. So let's take a look and analyze this a little bit more. Hold on tight. Yes, gold has edged up a notch after a 5 months high ahead of the Fed's policy update. We're going to get a report. They're meeting as of the recording of this video in Jackson Hole, Wyoming. And who knows, we shall see what happens coming when they announce the rate hikes or lack thereof tomorrow. Let's take a look at this article here from Market Watch. Gold prices on Tuesday marked a modest gain, enough to notch their highest finish in 5 months, finding some support on a weaker dollar ahead of a monetary policy update this week from the Federal Reserve. Traders eagerly awaited the federal bank's decision on interest rates, as well as hints of the Fed's pace for next year's expected rate increases when it issues its latest outlook for monetary policy on Wednesday. And gold on February delivery of COMEX, the futures edged up $1.80 or 0.1% to settle at $1,253.60 an ounce, the highest finish since the July 10th according to FactSet data. The contract has gained about 2.2% month to date. The special drawing rights gold shares ETFs, GLD, traded up 0.2% on Tuesday's, dealing and expanding with month to date gained to 2.3%. The dollar, as measured against the ICE US dollar index, is down 0.10%. Slightly Tuesday as gold futures settled with a week-to-date decline of 0.4%. A weaker U.S. unit typically boosts demand for commodities priced in dollars as it makes them less expensive to start of other currencies. Benchmark U.S. stock indexes, meanwhile, include the Dow Jones Industrial Average after falling into correction territory on Friday. And still, gold considered a safe investment during times of financial, economic, and political stress around the globe is up some 7% from a 19th-month lows hit in mid-August. The metal's on track to post its best quarter since March 2017. And again, I can't help but reiterate that it is not really an investment in and of itself. It is a hedge during times of financial, economic uncertainty and stress. The fourth quarter continues to shine a positive light on gold. Prices remain resilient. For short covering continues to wash out negative sentiment set by speculators in previous quarters this year, says Maxwell Gold, Director of Investment Strategy at Aberdeen Standards Investments. In a note, looking ahead to 2019, the outlook for gold appears more upbeat, as an uncertain macro and geopolitical environment will likely continue, potentially providing further boon to investment demand for gold. And we're going to touch on that with two other articles we're going to take a look at here. The Fed is widely expected to raise interest rates for the fourth time this year at its two-day policy meeting ending on Wednesday. A factor generally favorable for the dollar and negative for gold, but such a move has long been expected in financial markets, baked in, as I like to say. Plunging stocks markets and signs of slowing global growth may prompt the central bank to signal a slowdown in rate increases next year, analysts have said. Market expectations for 2019, once put at 3 to 4 more increases, have also begun to lessen on the back of dovish comments from Fed officials, including Chairman Jerome Powell. The Fed will be joining the Bank of Japan and the Bank of England, offering policy updates this week. The tailwinds of a weaker U.S. dollar and a more dovish approach to the Fed may push gold higher, particularly in the second half of 2019, where higher risk of recession are being priced in. Another metals trade, March silver fell 5.8 cents, or 0.4% to $14 an ounce. We already talked about palladium and platinum, but I think it's interesting. I don't think the Fed should raise rates when they announce tomorrow. I think they should just leave them where they're at. Although I think that if they do raise rates, it may have a very, very marginal impact on gold and silver prices because, again, I think a lot of this stuff has been baked in. Now, what will that happen? What will occur if they don't raise rates? If they do not raise rates, I believe you will see gold and silver go up, but I think it could stabilize the economy through the next year. I think the metals prices will react if they don't raise rates, and they will go up. Because that means that the Fed is really generally worried about the economy. Speaking of worry about the economy, Ron Paul is predicting a meltdown, a 50% correction will spark depression-like conditions that may be worse than 1929, according to this article from CNBC. Ron Paul is warning that this year's corrections could be a precursor to an epic market collapse that may come sooner than investors think. According to the former Republican presidential candidate, Wall Street is becoming more vulnerable to near-depression conditions within the next 12 months. Once this volatility shows that we're not going to resume the bull market, then people are going to rush for the exits, Paul said Thursday on CNBC's Futures Now. The relentless bearish former congressman added it could be worse than 1929. During that year, the stock market began hemorrhaging, falling almost 90% and sending the U.S. economy into a tailspin. Paul, a well-known libertarian, has been warning Wall Street a massive market plunge is inevitable for years. He's currently projecting a 50% decline from current levels as his base case, citing the ongoing U.S.-China trade war is a growing risk factor. I'm not optimistic that all of a sudden you're going to eliminate the tariff problem. I think that's here to stay. Tariffs are taxes, and I agree with him on that. However, I do believe that they could come to some sort of deal. I'm a little bit more optimistic about that. We shall see, though. The scenario is exacerbating Paul's chief reason behind the bearish call, 2008 financial crisis, easy money policies. He contended that the Federal Reserve's quantitative easing has caused the biggest bubble in the history of mankind. The everything bubble, really, is what it's been known as. It's so important to understand that the original cause of the problem, and that is the Federal Reserve running up the debt and letting politicians spend money, he added. Paul argued that Washington lawmakers do not have an ability to effectively fix the debt problem. And he's been highly critical of the 2017 Trump tax cuts for creating a dire debt situation. Well, the problem with the tax cuts is that it increases revenue into the Treasury. We saw this in the 80s as well, when by 1988, revenue almost doubled into the Treasuries. And what did Washington do? They spent it. So I do agree with him on that point. The White House is estimating this year's budget deficit will total $1.09 trillion. The Obama administration saw deficits just as large while trying to solve the 2018 financial crisis and the subsequent recession. However, there may be a silver lining in Paul's forecast. Pun may be intended, I'm not sure. Unlike the Great Depression, Paul said the next historic downturn doesn't have to last a decade as long as the Fed policy and lawmakers don't make the same financial mistakes. If you allow the liquidation, it doesn't last long, Paul said. I kind of agree with that. And Washington just needs to stop the spending that they've been doing. Let the free market take over. The free market will essentially correct itself. To that end, we have another article here from CNN Business from Alan Greenspan, former Fed chair, says the party is over on Wall Street. The former Federal Reserve chairman, who famously warned more than 2 decades ago about irrational exuberance in the stock market, doesn't see equity prices going any higher than they are now. It would be very surprising to see it sort of stabilize here and then take off, Greenspan said in an interview with CNN anchor Julia Chatterley. He added that the market could go up further, but warned investors that the correction would be painful. At the end of the run for cover. And I do believe we're kind of nearing that end right now, if we haven't already. Markets have staggered in recent weeks, with spooked investors selling over mixed messages coming from the White House concerning the status of trade negotiations with China and growing fears of global economic slowdown. The jitters come as the Federal Reserve's interest rate setting committee prepares to meet Tuesday and Wednesday. They're expected to raise rates for the fourth time this year, though investors will also be combing for clues on their plans for 2019. Minutes from the Fed's last meeting in November signaled policymakers want to make a more flexible approach next year, adding to investor anxiety. And on Monday, the S&P 500 closed the trading day at its lowest level since October of 2017, while the Dow Jones Industrial Average plummeted more than 600 points at one point in the day. The volatility is a function of how we speak, think, and feel, and it's variable. Unless you can somehow radically change human nature and how we respond, this is what you'll always get and have been getting. You have to count on it, and you're going to understand how the market functions. And that's just it. It's a lot of it is psychological, and the psychology of the recent couple of weeks with the volatility in the markets going up and down is going to wear on traders, and they are going to run for cover, I believe. Really, no matter what happens, I think people are spooked. They're saying we better get out while the getting's good, so to speak. He says that President Donald Trump has in recent weeks taken repeated aim at current federal chairman Jerome Powell, a former investment banker appointed by Trump. The president and a closed market watcher who has staked his presidency on the stake of the economy has accused Powell of trying to undercut him politically by slowing the economy down. He blamed the Fed and the market rout in October, calling the Fed out of control and suggesting Powell seemed to enjoy raising rates. He also later called the Fed a much bigger problem than China. And I don't know that I would go that far. But nonetheless, I do believe that the Fed were to continue on its path of raising rates this year and next year, it will have a profound effect on the economy. My guess is if they do raise rates in December here, when they do announce from their meeting, that it'll be the last time for a while. I believe that won't be the projected rates hikes next year. It'll all be interesting to see. I think either way, we're going to see gold take a move upward, and silver too. We'll see. Post your thoughts below. Would like to extend a multitude of gratitude to y'all for watching, and encourage you to please rate, comment, and subscribe.